Friday, September 22, 2017. Incredibly, it is fall. And here in Boulder, Colorado, where it is so dry, we might actually get some rain. This Friday, this point in time, I'm an information freak. Who would know? And I find myself rattled by the news of fake news. The idea that Facebook ran ads planted by Russians, Equifax, data breach for months that it didn't know had been breached. And this is one of the firms who has been trying to get us to hire it to protect ourselves from the consequences of data breaches. Anyhow, I served a 5-year sentence at a difficult school a long time ago. And if in a class one of us rose to offer a fact to the class, especially an unusual fact of some kind, the master would instantly respond, Mr. Barnes, that's very nice. On Monday you'll bring to all of us a short paper, 2 pages, footnoted as to your sources of this fact and further elucidation on the matter. And you learned in a hurry that if you thought it was a fact, you'd better be prepared to write that paper. And I do the best I can when I write on Fridays and when I do these videos to bring it to you as straight as I can. And I've got a deep fondness for raw data. If I'm going to chew on data and try to divine its meaning, I'd like to do the chewing. I'd rather not have pre-chewed data by somebody else who's got their own biases or whatever it is that they have to sell. And one of the best sources of data about the economy or anything else in the economic world is the Fed. The Fed has something like 1,000 economists on duty in DC, and every 90 days they publish a thing called the flow of funds, which is hundreds of pages of the movement and landing place of every nickel in the United States economy. And they don't jigger it. And I know there are conspiracy theorists out there who think that all government agencies make up everything they say, but Fed just plays it straight. And they don't offer any interpretation of the data. I mean, you can find speeches by Fed members, but the data itself is just data. Now, the Fed at the moment is confounded because we have this super low rate of unemployment, and wages are not growing, and inflation has been forecast to rise to 2% annually for most of 10 years and has failed to do so. And it's tough when one of your 100-year indicators all of a sudden breaks down, especially if it's the most important indicator you've got. So what's another one? Well, there are very few economic accelerations and almost no inflation accelerations without a corresponding increase in credit. You have to have fuel for the fire. It doesn't come just from nowhere. And in the flow of funds that was released this week, I wrote down the actual numbers. Some of the accounts are mortgage accounts. Another one is bank accounts. The H.8 release is total bank credit. Bank credit in 2017 is growing at the lowest rate since 2013, when the Fed thought that quantitative easing was still necessary. And bank credit during 2017 is growing at a rate about half of GDP growth. We're not sure what that means, but it doesn't mean inflation and it doesn't mean acceleration. Banks aside, banks included, the largest single credit accounts in the United States are mortgages. U.S. mortgages outstanding, 10 trillion. The growth rate in the first half of this year of mortgages outstanding is about 1.2%. Pre-inflation, that's about a quarter of the growth rate of the economy as a whole. Now that's residential loans. Multifamily loans, commercial loans, a little higher, but total multifamily and commercial loans outstanding are only about 1/3 of home loans. The accounts aren't that big, but even those accounts are barely growing at 3% annually. Home equity lines of credit are, in theory, the hot money in the economy. That's when the country feels so good about itself that it seems an easy thing to borrow home equity and spend it, maybe unwisely. Outstanding home equity lines of credit have fallen every 90 days since the beginning of 2016. A lot of things going on out there. A lot of them are puzzling, a lot of them are uncertain, but good sources. Credit's not the problem, and if credit's not the problem, neither is overheating nor inflation. Do have a good weekend, and I hope it rains a little where you are.